Hey everyone, welcome back to Finance Friday. It's another special edition of Money Girl where I answer your burning money questions. Today we have a great topic from an anonymous voicemail caller.
Hi Laura, I am a government contractor and I'm actually in the process of being laid off due to some cuts. Once I'm laid off, I'm not quite sure what to do with my 401k. I have about $30,000, I think, invested right now, but I have about $5,000 worth of bad debt, so credit card debt, some medical bills. So I'm wondering if I should use a portion of my 401k before rolling it over into a new 401k account to pay off that debt. I do know that I could be charged up to, I think, a 10% fee. Not quite sure if it's not or if it's a good opportunity. Just go ahead and get that debt paid off and kind of start anew, especially going into, a new job, potentially a new industry. Since, government contracting is a mess right now. But I would love your thoughts, and thank you in advance.
Anonymous caller, that's a great question, and I really appreciate you leaving the message. If you have a workplace retirement plan, like a 401k or 403b, there may be times when you're tempted to make an early withdrawal. And early is defined as being younger than 59 and a half. For whatever reason, that is the official retirement age that the IRS has said is the point where you are, going to pay a penalty if you make a withdrawal before that age. However, before you crack open your retirement nest egg, it's really crucial to understand your options. This podcast will review the rules for early withdrawals and the pros and cons of using retirement funds to pay off debt. Welcome back, everyone. It's episode 957 of Money Girl. I really appreciate you being here and spending a little bit of time with me. If you're new to the show, I'm Laura Adams, an award-winning author, on-camera spokesperson, money speaker, and founder of The Money Stack. That's my popular Substack newsletter. I would love for you to subscribe. It comes out pretty much every week. You can learn more, ask your money questions, and sign up for The Money Stack when you visit lauradams.com. Newsletter subscribers automatically receive my Money Success Toolkit with the exact templates I use to manage money. And you can sign up for free, or you can support the show as a paid member and get access to live educational events. Okay, let's talk about the 401k rules. I'm sure, most of you have heard of a 401k. These are really great retirement accounts. And for 2025, you can contribute up to $23,500 or $31,000 if you're over 50 to most workplace retirement plans. It could be called something different like a 403b, or maybe you have a 457 retirement plan. Basically, these are great accounts that many employers will offer, and they may even encourage saving by quote unquote matching your contributions up to certain limits. And that allows you to exceed those annual thresholds that I mentioned, the 23,500 and the 31,000. If you put in that much, your employer can allow you to exceed those limits with their matching contributions, which is great. So once the money is in the account, you choose how to allocate your retirement funds using an investment menu that usually includes options like index funds, mutual funds, and exchange-traded funds. These are all very simple types of diversified investments that you can, really easily select and allocate each of your contributions to. Now, in most cases, 401k plans allow participants to take loans and hardship withdrawals up to certain amounts. Now, hardships are very specific circumstances approved by the IRS, including paying for college, buying a primary home, avoiding mortgage foreclosure, making home repairs, or having unpaid medical or funeral expenses that are unreimbursed. However, taking money out of a workplace retirement plan for something else like, going on vacation or paying off credit card debt is not an approved hardship. So the IRS, they make it punitive to withdraw money from a retirement plan, so you won't do it. The longer your money stays invested in the account, the better off you'll be in the long run. So these rules are designed to keep that money sitting and cooking in the account. A primary downside of a 401k hardship withdrawal is that it is not tax-free. You have to pay income taxes on amounts that were not previously taxed, plus an additional 10% early withdrawal penalty if you're younger than 59 and a half. Plus, you typically can't contribute to your retirement account for 6 months after taking an approved hardship withdrawal. So you see what I mean? It's punitive. However, once you leave a job with a retirement account, your vested balance is yours to keep, and you've got several tax-free options. Now, as the caller mentioned, you can roll it over to a new employer's 401k. Another option for managing an old 401k retirement plan is to roll it over into an individual retirement account, or IRA. Now, my least favorite option for an old retirement plan is cashing out a portion or all of it. While it's allowed, as I mentioned, if you're under 59 and a half, you have to pay income taxes on amounts not previously taxed, plus that additional 10% penalty. Depending on your income, average tax rate, and whether you have a traditional or Roth account, that could end up depleting your balance by 25%, 30%, 35%, or more. So it's very expensive. In other words, if you have, let's say, $100,000 in your traditional 401k and you cash it out at age 40, after paying average taxes of, let's say, 20% and a 10% penalty, you're only going to have $70,000 in the account. That's a massive hit to your wealth. Now, I mentioned that some 401ks offer loans. While that's not what the anonymous caller is interested in because, they're saying they're going to leave their job, they've been let go, I want to explain to you briefly how they work. With a 401k loan, you tap a portion of your account tax-free if you repay it with interest over a set period, such as 5 years. And the interest rate is specified in your plan document, and it's, usually a reasonable amount. If you can take a 401k loan, the limit is half of your vested balance up to $50,000. For example, if you have $60,000 in the account, the maximum you can borrow is $30,000, okay? So that would be half of your vested balance of $60,000. If you repay a 401k loan on time, you won't owe income taxes or penalties, so it can be a good option. However, if you don't repay it on time, the outstanding balance, the entire outstanding balance, gets considered an early withdrawal if you're younger than 59 and a half. And in that case, yes, you would be subject to income tax plus that additional 10% penalty on the entire unpaid loan amount. Additionally, if you leave your job, get laid off, or are fired, your loan balance will be considered an early withdrawal unless you repay it in full by your tax filing deadline. Again, if you can't repay the whole thing by then, you will have to pay income tax plus that penalty if you're younger than 59 and a half. So, the loan could be a good option, but it also comes with some downsides. The main benefits of a 401k loan include getting funds quickly. You could literally get the funds in your bank account within a week or two. Paying a relatively low interest rate compared to credit cards or a personal loan. Spending it any way you like. And having a set repayment term, like, as I said, is typically 5 years. The primary downsides of a 401k loan include missing potential investment gains on withdrawn amounts and paying an expensive penalty if you don't repay it on time. All right, let's talk about using a 401k to pay off debt. If you can do it, if it's a good idea. While you're employed, you can typically use a 401k loan, but not a hardship withdrawal to pay off debt. As I mentioned, the IRS narrowly defines hardships for workplace retirement plans, and avoiding foreclosure on a primary home is the only allowable debt. However, once you're no longer employed, you can do anything you like with an old retirement plan. And, this is what the anonymous caller is asking. I strongly recommend rolling it over to an IRA so you keep it invested and avoid taxes and penalties. As I mentioned, cashing out some or all of it is an option, but it rarely makes sense due to the high costs. Now, the anonymous caller didn't mention the interest rate on their debt, but let's say it's 15% or 20% on credit cards or loans. Yeah, that's a high rate. However, paying income taxes plus an additional 10% penalty before age 59 and a half would likely be even more expensive. The average tax rate for the majority of Americans is in the range of 15 to 25%. And, that would bring the total cost of an early withdrawal from that amount to 10% more, so going up to 25% to 35%. In addition, the caller would incur an even greater loss when considering the lost compound growth in the account over time. Using retirement funds to pay even just a $5,000 debt certainly solves a short-term problem, but can dramatically reduce your future financial well-being. For instance, keeping $5,000 invested for 3 decades with a 7% average annual return would yield over $40,000. So tapping your retirement account should be a last resort because you forfeit significant potential account growth. Plus, if you don't have enough cash to pay those taxes and the penalty, you might have to withdraw more from the account than you actually need, leaving you with even less in your retirement account to grow. Therefore, the best advice I can give the anonymous caller is to roll over the entire 401k balance into another retirement account and avoid cashing out any amount of it. The long-term damage would simply exceed the short-term relief of paying off a relatively small amount of debt. So instead of draining a retirement account to pay off debt, I'd like you to consider other options that make sense for your financial situation. So we'll go through a few of them. The first is simply budgeting to radically cut unnecessary expenses for a period so that you've got more money to send to creditors. If you haven't already scrutinized your expenses, there may be categories that you can, pretty easily reduce, giving you more financial breathing room. Alternatively, you may have options to increase your income with a higher paying job, a second job, or a temporary or permanent side hustle. Maybe the next job that the anonymous caller lands will come with more money, and that would allow, a little bit more aggressive debt payments. Okay, another option is getting a home equity line of credit or HELOC. This would be for homeowners who have enough equity. That may allow you to pay off higher rate debt with a relatively low rate loan or line of credit. Now, the downside is that you could face foreclosure if you're unable to pay a loan that is secured by your home. You might consider taking out a personal or debt consolidation loan with a relatively low interest rate, especially for those with good or fair credit. That could reduce your interest expense significantly. The downside is that having a short repayment term, such as 3 or 5 years, comes with higher monthly payments that you've got to be ready and able to afford. You might consider using a balance transfer credit card. These have a low or no interest promotional period, such as 12 or 18 months, which allows you to move higher rate balances to a new or even an existing card. This strategy is most effective when you can pay off the full balance interest-free before the promotion expires. You might think about negotiating a debt settlement. That could be an option if you're soon going to miss a payment, or let's say you're already behind on payments. You can contact creditors directly and let them know, you're dealing with a hardship, and see if you can negotiate what you owe or ask for them to temporarily suspend your payments. Now, this can negatively affect your credit, but it may be worthwhile if your credit scores have already declined. And you might think about obtaining nonprofit credit counseling. This can include debt solutions offered at no cost or even a very low cost, such as a debt management plan. That consolidates debt into a single monthly payment, often with reduced interest rates and lower fees. Counseling services, such as those offered by Money Management International, you'll find them at moneymanagement.org, can also help determine if you're a good candidate for a debt settlement or even bankruptcy, in severe cases. Those options certainly do have negative consequences for your credit, but can give you a clean slate after a financial hardship. A big thanks again to the caller. I think the takeaway for this show is that withdrawing retirement funds to pay debt is typically unwise because you likely have better options. So make a goal to keep as much invested so your financial future is as safe and secure as possible. If you're enjoying Money Girl, please take a moment to let us know you're getting value from our weekly episodes by rating and reviewing the show in your podcast app. I would really appreciate it. Everyone on the QDT team would also appreciate it. That's all for now. I'll talk to you soon. Until then, here's to living a richer life. Money Girl is a quick and dirty tips podcast, and we've got a great team that works on the show, and I want to thank them. Steve Rickyberg audio engineers the podcast. Holly Hutchins is our director of podcast. Morgan Christensen is our advertising operations specialist. Rebecca Sebastian is our marketing and publicity manager, and Nathaniel Hoops is our marketing contractor.